The Phoenix multifamily market has proved resilient in the 6 months since the onset of the pandemic. Much of the Valley's positive performance is because of Phoenix's competitive advantage as a low-cost market, especially as the need for affordable housing rises during this period of economic volatility. Performance has been assisted by federal and state stimulus offered to tenants, while conditions have also been somewhat stressed due to Arizona's eviction moratorium, which was further extended by the CDC's eviction moratorium through the end of this year. Progress is being made on a hefty construction pipeline here in Phoenix. Because nearly all of the new developments are top-tier apartments, affordability has become a growing concern for some of the most vulnerable renters. I'm Carrick Sears, Senior Advisor with SVN Desert Commercial Advisors in Phoenix. Now that the third quarter has closed, I want to bring you an overview of where the market is right now and where we see it is headed. One of the best indicators for the health of the apartment market is the daily asking rent tracker that's available on apartments.com. In Phoenix, asking rents have well surpassed the pre-pandemic peak by about 1.5%, making it one of the best performing markets in the country for rent growth, a title Phoenix has held on to for the last 2 years. Here, we compare the rents on one-bedroom apartments in Phoenix to the national index. Initially, the asking rents in Phoenix mirrored the national average. Rent levels fell in March and then began to stabilize in May. But this is when we start to see Phoenix market really taking off and diverging from the US average as Phoenix rates steadily climbed and national rents continued to stumble and inch down again in late summer. Weighing down the national average is expensive and dense markets like San Francisco, San Jose, LA, and Boston, all of which faced continued rent reductions. Not all the areas of Phoenix are out of the red. Rents in some of the urban markets like North Scottsdale, Camelback, Old Town Scottsdale are still below the March peak. On the other hand, affordable and high-growth suburban markets are leading the way for rent growth. In the East and West Valleys, new construction has not kept pace with household formation, and apartment demand is very healthy. Asking rents in these submarkets is more than 2% above where they were in March, as you can see here. Overall, the use of concessions in the Phoenix market is up from the start of the year. About 28% of apartment communities offered concessions in September, compared to about 15% back in February. Concessions are the highest in the most expensive and dense submarkets where we see rent growth has not quite recovered yet. In these areas like downtown Phoenix, 6 to 8 weeks of free rent has become the norm for newly delivering properties. In high demand and affordable submarkets, concessions are much lower, averaging around 1 to 2 weeks for properties that are in lease up. When we take a look at the availability rate data, we can see why concessions are so much higher in Phoenix's urban and dense areas. Availability has climbed in the urban areas like downtown, Midtown, Scottsdale, and Camelback corridors, while at the same time the rate has held much more steady in affordable suburban areas like Deer Valley, Arrowhead, Glendale, and East Mesa. That spread was caused by more people looking to save money by moving to the suburbs. But those higher concessions in urban areas look to be working since availabilities have trended downward since June. Overall, apartment demand was strong in the third quarter as Phoenicians were called back to work and renters began to move again. Absorption outpaced supply and vacancies contracted to 6.5%, which is healthy for Phoenix. That's the result of substantial population and job growth over the past several years, combined with a single-family industry that really hasn't kept up with demand. Despite the substantial job losses in first quarter, the Phoenix economy has still been the best performer among large metros. Looking at the baseline employment forecast, Oxford Economics anticipates that the job growth we've seen over the past several months will gain momentum, and Phoenix is expected to regain all of the jobs lost during Q1 by mid-2022, which is when net absorption will return to the historic average. But first, the market must absorb a record level of new supply that will deliver over the next several quarters. More than 18,000 units are under supply right now, under construction, and this will expand the existing inventory by about 5.5% once they're completed. And these levels are much higher than they were during our previous boom back about 15 years ago. Of course, some areas of Phoenix are more vulnerable than others based on their supply pipeline. Downtown Phoenix has the most inventory underway with almost 4,600 units. Once completed, that will increase the inventory there by about 14%. Gilbert also has a significant amount of new construction, though suburban areas like Gilbert are likely to outperform their urban and more expensive counterparts. About 2,000 units are underway in the West Valley, but this is a small percentage of overall inventory, and vacancies in this high-growth suburb are below the market average. Unique to this area is the prevalence of single-family build-to-rent communities. These rentals account for almost 1/3 of apartment construction here, and this trend is expected to continue since the planning pipeline is full of these projects. Numerous luxury mixed-use apartments are under construction in the Roosevelt Row of downtown Phoenix. The largest project is Trammell Crow's The Fillmore, planned to deliver in late 2022. And within a half mile of that site, there's a total of 7 multifamily communities under construction. And within 1 mile, there are 12 properties underway. Our local outlook is much more favorable than the nation as a whole, especially as people look to affordable metros for job opportunities. Still, Phoenix will face challenges from the lingering effects of the pandemic. Another hindrance to multifamily demand is the historically low mortgage rates that are enticing some high-income renters to home ownership. By the way, some communities have reported increases in tenants breaking leases because they bought a house. But the tight supply of single-family homes and strong price appreciation will limit this impact. In our base case scenario, apartment demand is anticipated to fall short of elevated levels of new supply over the next several quarters. That imbalance will push up vacancies near 7.5%, making this apartment cycle far different from what we witnessed in 2009. By 2022, when Phoenix employment is expected to fully recover, vacancies will stabilize and begin to edge down again. The rise in vacancies will cause Phoenix's long stretch of robust rankings to moderate over the next few quarters. Next year, rent growth will be flat, but rents will gain steam again by 2022. Sales volume has accelerated over the past several months, but remains below record levels of activity recorded over the last several years. In the third quarter, about 90 properties over 10 units traded hands, compared to about 140 properties that traded during the same time period a year ago. The transaction prices on these properties rose about 3.5% year over year, which is below the 8% increase that we saw in CoStar's pricing trends, which estimates prices for all of the apartment sales. The difference reflects the basket of properties that traded hands in recent months. It consisted of a lower percentage of Class A apartments than last year. Out-of-state and opportunistic buyers are heavily targeting mid and lower tier properties with value add potential. We'll dive more into these third quarter sales statistics when we release our multifamily dashboard report in the coming weeks. Whether you want to buy, sell, or just hold on, I'd love to help you maximize your ROI. Please give me a call at 480-425-5529. Thank you.